Hello, and welcome to the next installment of Diversified's Asset Class and Manager Spotlight. My name is Mike Horwath, and I'm the Chief Investment Officer here at Diversified Lifelong Advisors. And today we're going to get a little bit away from any specific asset class or any specific investment style. And I thought it's a question we get quite often. I thought it'd be smart to take a step back and talk about our manager selection process and really our portfolio construction process at its highest level. So what is the process with which we kind of start from the highest level and then eventually turn to implement into the actual investments and the actual allocation for our client portfolios? So the process starts really with understanding our portfolio objective. At Diversified, we really focus on equity and fixed income, managing our equity portfolio, which is our stock portfolio, our growth piece, and our bond portfolio, our fixed income, our stability and current income. But it's important whenever you're creating a portfolio that you understand what the actual objective of the portfolio is. Are you looking for growth? Are you looking for stability, income? Are you looking to be very diversified, very concentrated? There's many different ways to implement a portfolio and different objectives that you can take, but it's important that you understand when you're creating your portfolio what the actual objective is. From there, we tend to create our asset allocation targets. So asset allocation targets are when we look at all of available asset classes and we look to see how much in each one we should have. Right, there's a lot of research that goes into this. We create our biases. Maybe we prefer US over international. Maybe we prefer large cap over small cap. Maybe we prefer a specific style of investing. Maybe growth stocks, right? Technology, healthcare, maybe consumer discretionary, different types of sectors that we want to target. Maybe they lend themselves towards certain investment styles. And then we'll go through our manager selection process, which I'll discuss here in a minute. And then lastly, it is so important that you actively oversee your portfolios, you review your portfolios, and you make tweaks, tilts, changes, whether it's at the asset allocation level or if it's at the manager level. So on the screen, you're going to see an example of an asset allocation target. More than anything, when you think about this type of framework, this is an example of an equity portfolio. So what you're going to see is, we're going to create some sort of target based upon our research, based upon, our beliefs, based upon economic data, what we believe is going to happen in the short term. Also, we have beliefs over the long term, right? We want to remain diversified over the long term. Maybe we want to target certain areas over the long term. We'll, formulate all of these beliefs, and then we'll translate them into some sort of framework for asset allocation. So this is just an example. This is not our actual framework, but I wanted to share with you what it could look like, what it should look like, and how you may think about creating your asset allocation. So once you have your asset allocation, then it's time to say, okay, well, what do I want to do from an investment standpoint to implement that specific asset class? If I'm focused on dividend-focused stocks, if I'm looking to replicate the S&P 500, if I'm looking for emerging market stock allocation, well, what do I use to implement? One of the greatest challenges for investors right now is that there's 16,000 mutual funds. There's over 3,000 ETFs. There are a lot of individual investment options and managers and strategies that you can implement, and it's a constantly evolving field. How do you weed that down? It's great that you have a lot of options, but how do we, weed that down for you? So our manager selection process, our investment selection process is really three phases. One thing we'll do at the very beginning is understand, are we going to try to be active or are we going to try to be passive? So if we're going to be passive, that means we're just going to buy the index of that asset class. The S&P 500 is a great example. So if we're just trying to replicate the S&P 500 index because it just gives us broad allocation to US large cap stocks at a very low cost, it's a great way to manage the cost in our portfolio, and it's going to be one of our bigger allocations. Well, let's just go passive. Okay, so once we understand that we want to go passive, we know what we're looking for, well, then we go find the best way to implement that theme in our portfolio. Maybe we go buy a mutual fund. The Fidelity 500 index is 1.5 basis points. But you can look at other providers, other ETFs. They can be mutual funds. Big institutions will actually do this with individual stocks and be able to replicate it. You have to have a substantial amount of investments, but you can do it in different ways. But that's one way to passively access these investments. But then if we say we want to access it with an active manager, we want to go find a manager that specializes in an area, say emerging market stocks or say small cap growth stocks, we need to go work through our technology and find all of the managers and work through them. So in our process, we look at it as a 3-phase process. Phase 1 is taking all of those managers and screening them down for us. So what we're trying to do is take the 150 emerging markets managers and weed them down through quantitative screens to say, we want to look for very specific criteria and narrow that down to maybe 10 names. So things that we're going to look at in this phase are going to be return profiles, risk-adjusted return profiles, the turnover, so how much they trade in their portfolio. The cost is very important. The manager tenure, so how long has that manager been there? Things like that. There's typically over a dozen different data points that we're going to work through to try to narrow this down. The objective in phase 1 is to get this list of 100, 150 managers down to about 10 that exemplify certain characteristics that we really like. In our second phase, we're going to take those 10 managers, and our objective is to get it down to about 5. In this second phase, though, we're still going to focus on mostly quantitative data. We're going to look at the risk-adjusted returns, things called batting average, turnover, the concentration of portfolios, returns in different market environments, different things like that that can really get us into the nitty-gritty of what we should expect, what's happened, how long the manager's been there, and the return since the manager's been there. Many funds have been around for decades, but their manager may only be there for 5 years. Is it fair to look at a 20-year track record of a strategy when a manager has been there for 5 years? Things like that are important. It's important to understand, and it's things that we really look at the most detailed level. Our objective, though, is to get those 10 names looking at quantitative data down to about 5. That last phase is taking those 5 managers and going through a qualitative interview process. We want to talk to every team that we invest with. So that last phase is interviews with the teams. It's understanding who they are, what they do, what their philosophy is, what their process is. We call it the 4 Ps, the philosophy, the process, the people, and the performance. All right, so the 4 Ps help us drive our framework of who these people are, what they do, what are they good at, what's their belief in markets, how do they get to their belief, and things like that. At the end of the day, that third phase should give us the manager plus maybe 1 or 2 that we would act as backups to the manager that we want to implement with. Now, we'll do this if we're looking for a manager actively. We'll also do it just to make sure we're using a manager that we're happy with. We want to take our current managers and move them through this same process. So that's really our 3-phase manager selection process from start to finish. It can typically take anywhere between 1 and 3 months to go through this process because we want to be diligent, we want to understand who we're investing with, we want this to be a long-term relationship, so it's important that we take our time and we do things the right way. From an oversight standpoint, it's important that you always keep an eye on your portfolio. So really quickly, from our perspective, just know that we're looking at things daily, weekly, monthly. We have different reports that we run at different times and different frequencies. On a monthly basis, we dive into our models and look at our managers, how they're performing. So on the screen, you'll see example of performance metrics that we'll run on a monthly basis to see how are they tracking. Has there been consistent underperformance, and do we need to understand why that's happened? Is it something we would expect, or is it unexpected? Should we conduct a call? We already conduct typically quarterly calls with our teams, but this lets us know if there's something in between there that we need to discuss. But it's important that you conduct oversight and you're monitoring how your managers are performing, whether or not you want to stay active, maybe go passive, or vice versa, maybe you want to go from passive to active. Whatever that happens to be, constant model oversight is important. At Diversified, we have a 4-person investment committee who looks at this stuff weekly, who discusses this stuff weekly. So it's important that you understand from our perspective that this is being done on a very, very frequent basis, and we take it very, very seriously. So in summary, our process really starts with understanding what our portfolio objective is. We go into an asset allocation target. What do we want our portfolio to look like, whether it's all stock, whether it's all bonds, or maybe some mixture of the two? What does that model need to look like? From there, we need to make the decision. Are we going active? Are we going to go passive? Are we going to use funds? Are we going to use ETFs? And then we'll take the world of investment options through a manager selection process to make sure we're implementing at each level in each asset class the right investment for our clients. And then we need to oversee all of that, make sure we're happy with the asset allocation, start this process over. Do we need to change our asset allocation targets? Do we need to change our managers? This is something we look at daily, weekly, monthly, across many different levels, whether it's our investment committee, whether it's myself, whether it's with our entire firm, having discussions on what we're doing and why we're doing it. It's important to know that we are overseeing and we're monitoring and we're making changes on a constant basis. So I hope this has been helpful. I thought it'd be helpful to kind of get under the hood of what we do, why we do it from a manager selection process, because it's a common question, and I understand why our clients ask us, why do we choose a certain investment, or how do we get to a certain investment or certain allocation? This is kind of the process. Can certainly go more granular over time, and I look forward to maybe touching on every one of these parts of the process in the future. But once again, I hope you found it valuable. My name is Mike Horwath. I am the Chief Investment Officer here at Diversified Lifelong Advisors. Take care, stay healthy, stay wealthy, stay happy. Talk to you soon.